Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of Cardinal Health Inc., ticker symbol CAH. We're looking at Cardinal Health today both as a subscriber request and because Cardinal Health is a dividend aristocrat. So dividend aristocrats are companies that are members of the S&P 500 who have consecutively increased their dividend payouts for each of the past 25 years. Cardinal Health has increased their dividends consecutively for the past 35 years. Additionally, Cardinal Health just recently hit its 52-week high, and they've done extremely well over the past year, so it'll be an interesting business to look at today. Currently, Cardinal Health is trading for $79.52. Over the last year, their stock price is up 58%, which is in just very, very strong contrast to the market overall. They are one of the highest performers in the S&P 500 so far this year. Over the last 5 years, things are much more down to earth for Cardinal Health. They're compounding their stock price at a rate of 4.5% annually. Over 10 years, they're compounding at a rate of just under 7% annually. And going back prior to the global financial crisis, over the last 18 years or so, Cardinal Health has only compounded at a rate of about 2% annually. Keep in mind that this is not including their dividend payouts over this time, and currently they're paying a 2.5% dividend yield. So Cardinal Health is only 38 cents below their 52-week high. They're up more than $30 from their 52-week low. Just under 6% of their shares outstanding are currently sold short, so there is some short interest around this business, and they have a $21 billion market cap. For more background about the company, Cardinal Health is a leading pharmaceutical wholesaler engaged in the sourcing and distribution of branded, generic, and specialty pharmaceutical products to pharmacies through retail chains, independent pharmacies, and mail-order pharmacies, hospital networks, and healthcare providers. Along with AmerisourceBergen and McKesson, the three compose well over 90% of the U.S. pharmaceutical wholesale industry. Cardinal Health also supplies medical surgical products and equipment to healthcare facilities in North America, Europe, and Asia. Cardinal Health is also involved in some collaborative agreements, and Cardinal Health Inc. was founded in 1979 and is headquartered in Dublin, Ohio. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Cardinal Health based off of their business fundamentals. This analysis is an evolving process, so it will continue to improve and get better over time. It's also an opportunity to learn in public, so with that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. So there are a couple of reasons for this. The first is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these business returns are going to be captured here by return on capital. The second is that the average publicly listed business earns about a 7% return on capital. So by looking for businesses that are earning 14% returns on capital or higher, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. Cardinal Health has managed to increase their returns on capital since 2020. Over their last 12 months, they're earning 23% returns on capital, and averaged out over this time, they're averaging about 14.5% returns on capital, so just above the metric we're looking for, and about twice as good as that of an average business. So this is a check to start things off on metric number 1. Metric number 2, here we're taking a high-level overview of the cash coming into their business. We want their revenues, earnings, and free cash flows to have grown over the last 5 years. This metric is all or nothing in nature. Either all 3 of these are going to be up for a check, or if even one of them is down, this entire metric will be an X. So given the nature of Cardinal Health's business, they bring in a ton of revenues relative to the free cash flows that they're bringing in for their business. Pharmaceutical wholesaling has very, very small margins, and we previously looked at McKesson, which this is also the same type of profile here for their cash. Over this time, Cardinal Health has increased their revenues by more than 25%. They've also managed to grow their free cash flows by about $400 million from fiscal 2018 to fiscal 2022. However, at the same time, their earnings are down. They actually had negative earnings in 2 of these years, and this past year they lost about $1 billion. So their earnings came from an impairment of goodwill, basically meaning that they're writing down one of their previous investments. And so this is going to be an X on metric number 2. So for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Cardinal Health on a per share basis. We're looking for earnings per share growth over the past 5 years. Again, their earnings are down over this time due to that impairment of goodwill. In 2020, their earnings were down significantly because of a legal settlement that the company had to make. So if you're interested in learning more about the background of either of those 2 charges, it would be helpful to dig into the company's filings to learn more. Even though their earnings are down over this time, their earnings per share are not down at the same rate that their earnings are. And this is because Cardinal Health, in a move that's seemingly good for shareholders, has repurchased about 11.5% of their shares outstanding over the last 5 years. So this is important because when you purchase a share of stock, what you're really buying is a fractional ownership percentage in that business. So when a business buys back shares by decreasing the amount of stock that they have outstanding, they're actually increasing your ownership percentage in the business, which is going to increase your percentage of the business's profits going forward. So even though their earnings are down over this time due to these one-off charges, as a long-term investor in the business, your percentage of the business's profits have increased by 11.5% over the last 5 years. This is an X on metric number 3, but it's not the worst thing here. Next up, metric number 4 is going to be very similar. Here we're looking for free cash flow per share growth over the past 5 years. So in contrast to their earnings, their free cash flows are up over this time, and coupled with their buybacks, their free cash flows are up at a rate that's faster than their free cash flows, as the numerator of their cash flows has increased, while the denominator, their shares outstanding, has decreased over this time. So this is a check here on metric number 4. One thing we also want to point out here is that usually we're looking for a business's earnings and free cash flows to be roughly the same over extended periods of time. So while this is not necessarily the case for Cardinal Health over the past 5 years, a lot of this has to do with these one-off charges, this legal settlement in 2020, and then this impairment of goodwill in 2022. It's worth mentioning that the fact that their cash flows are higher than the business's earnings is likely a good sign for Cardinal Health, even with the discrepancy between the two here. Really what we're concerned about is if the business would have a ton of earnings and very little free cash flows, that could be potentially indicative of certain things like aggressive accounting, or in some of the extreme cases, like with the case of Enron, outright fraud. So that's likely not what we're seeing here. And so even though these are off over this 5-year time frame, that's likely not that bad for this business. Anyways, through our first 4 metrics, we are split evenly. We have 2 checks and 2 X's. Then next up for metric number 5, here we want their net debt, which is long and short-term liabilities minus cash and short-term investments, to be below the amount of free cash flow that Cardinal Health has brought in over the past 5 years. So this is going to help us evaluate how the business is utilizing leverage. At the end of their fiscal 2022, the business had $1.1 billion in net debt. Currently, they have about $1.8 billion in net debt. And over the last 5 years, Cardinal Health has brought in more than $11 billion in free cash flow. So that is plenty of free cash flow to be able to support this debt load. They'd be able to pay off all of their net debt with only 1 year's worth of free cash flow. So this is a check here on metric number 5, as it looks like the business is highly cash flow generative relative to the debt they're employing in their business. And they've been more or less steadily paying down this debt over the past 5 years. Then our 6th and final metric, the big metric of them all, we want their average free cash flows to their total enterprise value to give us a yield that's above 5%. If this is the case, this will give us a slight risk premium to the rate of the 10-year treasury yield and give us another reason to potentially be interested in Cardinal Health. So we're using their total enterprise value because it's going to give us a picture of the business's economic reality that's going to be more similar to as if Cardinal Health were a private company and likely more accurate for the economic reality of the business. So total enterprise value is going to take into account both their market cap and their net debt position. Currently, Cardinal Health has a $22.6 billion total enterprise value. And we learned that over the last 5 years, Cardinal Health has produced $11 billion of free cash flow. This means that in an average year, they're producing $2.2 billion of free cash flow. So when we divide their $2.2 billion of average free cash flow by their $22.6 billion total enterprise value, that gives us an average free cash flow to enterprise value yield of 9.7%. So this is a check here on metric number 6. Based off of their historical abilities to bring in free cash flows, the business does look like it's giving us a potentially attractive risk premium to the rate of the 10-year treasury right now. Additionally, Cardinal Health has actually increased their cash flows over their last 12 months at a rate that's been way above where they've been at historically. So they brought in $3.4 billion of free cash flow over their last 12 months. So to get a current free cash flow to enterprise value yield for the business, when we divide their $3.4 billion of their last 12 months of free cash flow by their $22.6 billion total enterprise value, that gives us a current free cash flow to enterprise value yield of 15%. So again, that's a seemingly very attractive risk premium to the yield of the 10-year treasury right now. So once again, this is a check on metric number 6. Even though this is potentially such a strong risk premium, keep in mind that this is just one data point out of this entire holistic analysis. You want to think about the business in its entirety, but it does seem like Cardinal Health would be an interesting business to learn more and do deeper research on. Then finally, here we're looking at Cardinal Health's dividend profile. So as mentioned, Cardinal Health is a dividend aristocrat. They've consecutively increased their dividend payouts for each of the past 35 years. Additionally, Cardinal Health is also paying out a 2.5% dividend yield, which even with their massive run-up in their stock price this year, is still better than that of the yield of an S&P 500 ETF right now. So despite that historical track record and their above average yield, it's still very important that if you're potentially interested in a business for its abilities to pay out dividends, that you stop and look at the underlying fundamentals of that business and determine whether or not that company's dividend payouts are well supported by their earnings or their free cash flows, depending on the type of business. For Cardinal Health, we want their dividends to be supported by their cash flows. And so in all 5 of these years, it's no surprise that Cardinal Health, as a dividend aristocrat, has consecutively increased their dividend payouts. They've also managed to grow their free cash flows overall over this time frame. And in all 5 of these years, they produced more than enough cash flow to be able to comfortably support this dividend payout. Their highest dividend payout ratio came in at only 35% in 2020. And so that is very conservative, especially relative to a lot of other businesses. Typically, we want a business to keep their dividend payout ratio below 60%, so Cardinal Health seemingly has a lot of room to spare. As long as they keep up these strong cash flows, it's reasonable to expect that Cardinal Health will continue growing their dividend for a significant while to come. Again, this is just a snapshot of their past 5 years of performance, so it's no guarantee for the future though. Then finally, here we're using a discounted cash flow model to come to a potential fair value for Cardinal Health. So starting with an average of their free cash flows per share over the past 5 years, which again would be currently down below where their current free cash flows are at because their current last 12 months of free cash flows are significantly above where they've been at historically. Then projecting these cash flows per share out over the next 20 years, using historical growth assumptions based off of Cardinal Health's abilities to grow their free cash flows in each of the past 32 years, so dating back all the way to 1990. These are assumptions that you should either validate or invalidate for yourself through further research and confirm whether or not these should be potentially applicable as an estimated baseline projection for Cardinal Health going forward over the next 20 years. So using a growth stage over the next 10 years where they grow their average free cash flows at a rate of about 7.5% annually, and then using a terminal stage for the 10 years out after that, so projecting 20 years out into the future in total, where their growth rate falls by about half and they only grow at a rate of 4% annually. We're not adding in their tangible book value because that is significantly skewed by how the accounting is done for their share buybacks. Again, they've repurchased about 11.5% of their shares outstanding in the last 5 years alone. Then it looks like from today's valuations, you could reasonably expect about a 15% rate of return going forward from Cardinal Health, with a potential fair value for the business of about $81.60 per share. So there are some major caveats to this. One is that this rate of return would be including their dividend yield. So currently they have a 2.5% dividend yield right now. Two is that this return would be massively outpacing what Cardinal Health has done over the past 18 years. If these assumptions would be potentially accurate going forward, it would be a major uptick for the business. The third, and very importantly, is that these are based off these historical assumptions, which you need to validate or invalidate for yourself and do more research on. You have to do your own homework here, and there are a number of reasons why this might not be potentially accurate going forward for the business. It's just up to you to learn more about the company to understand whether or not that's correct. A discounted cash flow model, just like any other model in any other discipline, is going to have its outputs be highly dependent on its inputs. And then finally, and most importantly, this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered financial and legal professionals. So in summary, Cardinal Health checks the box on 4 out of 6 of our metrics. They're earning average returns on capital of about 14.5%, while their revenues and free cash flows are up over the last 5 years. Due to an impairment of goodwill, their earnings are down over this time. Cardinal Health has also managed to repurchase 11.5% of their shares outstanding over the last 5 years. And relative to their free cash flows, the business is employing very little amounts of debt, very modest at best, and they'd be able to pay off all of this debt with only 1 year's worth of free cash flow in any given year. Then, both on a current and an average basis, their free cash flow to enterprise value yield looks like it's giving us a potentially attractive risk premium to the rate of the 10-year treasury yield right now. And so it's likely worth your time to dig in and learn more about the business going forward. Looking at their dividend profile as a dividend aristocrat, they've incrementally grown their dividend at best, typically adding on only a few cents worth as a payout to shareholders, but they're still paying out a 2.5% dividend yield right now, and they're being very conservative in how they're paying out their dividend. They have not paid out more than 40% of their cash flows in any given year as dividends, which would seem to indicate that the company is going to be able to sustainably grow this dividend going forward into the future. So Cardinal Health could potentially be a future dividend king contender. They would need 15 more years of increasing dividend payouts to hit that dividend king mark. Then finally, performing a discounted cash flow analysis of the business using historical growth assumptions, which you need to do your own homework on to determine whether or not these are going to be potentially applicable to give us an estimated baseline projection going forward for Cardinal Health, that from today's prices, you could reasonably expect about a 15% rate of return going forward over the next 20 years. Again, keep in mind that there are some major caveats to that. One of them being that over the past 18 years, the business has only returned about 4.5% compounded annually at best. So this rate of return going forward would be much, much higher than that, about 3 times better. And so there are a number of reasons why that would potentially be inaccurate going forward. And so ultimately, you're just going to need to do your own homework to understand what's going to be appropriate for this business in more depth. It's worth reiterating that this type of analysis is not financial advice. It's not a buy or sell recommendation of any security. And before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. Instead, this analysis serves as a beginning and holistic understanding to help you determine whether it's worth your time and energy to dig in and learn more about Cardinal Health. So one resource that will definitely help you stay up to speed with what's going on in the market and will help you learn more about Cardinal Health is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks, but over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's own algorithm. You can also see earnings call transcripts, investor presentations, SEC filings, and press releases all in one space. You can add your own margin of safety targets and get alerts when your favorite stocks hit that target. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years worth of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make your research easier. And if that didn't convince you, the best thing is that an annual plan is only $99 right now through my referral link down in the description below. Normally premium is $239, but they are currently running a general offer for $119. But if you use my link, it's only $99. So check it out if you're interested. As a value investor, through this deeper research, you're ultimately trying to understand the business as if you're going to own 100% of it, and you can truly understand the essence of the business and understand what's important and what's not important for the company going forward. So as you do this deeper research, you'll learn more about the business's qualitative and quantitative aspects, and will be able to determine for yourself what a reasonable, appropriate intrinsic value for Cardinal Health should be. So with that said, that's it for today's fundamental stock analysis of Cardinal Health Inc., ticker symbol CAH. If you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time. Cardinal Health was a subscriber request, and they're a dividend aristocrat, so I'm happy to make an analysis of the company. Thanks for learning about Cardinal Health with me, and have a great day.